Silver isn't moving the way people expect, not like a normal asset, not like a commodity responding to supply and demand headlines, and not like something driven purely by speculation. What's happening in silver right now feels different, quiet, controlled, almost deliberate. Prices rise, but not explosively. Pull back, but not decisively. Break levels, then pause. To most observers, it looks like another cycle, but history suggests something else. Because when a critical asset begins to move slowly during a period of rising systemic stress, that is often not a sign of weakness. It's a sign of release. This documentary is about that idea, not silver hype, not price targets, not promises, but patterns. Because throughout history, when confidence in monetary systems weakens, certain assets are not allowed to surge freely. They are managed, buffered, metered, until they aren't. And by the time that control loosens, the move no longer looks like a rally. It looks like repricing. To understand why silver may be entering that phase now, we need to step back. Not years, centuries. Every monetary system, regardless of technology, rests on the same foundation. Trust. Trust that currency will hold value. Trust that debts will be honored. Trust that savings will not be silently diluted. When that trust is strong, precious metals are boring. They sit quietly, ignored, dismissed as relics. But when trust weakens, metals don't rise immediately. They are restrained. Because uncontrolled metal prices send a signal. And that signal is dangerous. Throughout history, governments and financial systems have understood this intuitively. When gold or silver rises sharply, it tells the public something is wrong with the money. So the first response is rarely panic. It's containment. This has happened repeatedly. In ancient Rome, silver content in coins was gradually reduced rather than openly devalued. The price of silver didn't explode. The money quietly weakened. In medieval Europe, rulers clipped coins rather than admit fiscal stress. Again, metals were managed. In the 20th century, governments didn't let gold trade freely when currencies were under strain. They fixed prices, restricted ownership, controlled flows, not forever, but long enough to maintain confidence. Because confidence, once broken, is nearly impossible to restore. Now consider where we are today. Debt levels are historically high. Interest costs are rising. Central banks are constrained. At the same time, trust in institutions is fragile, not collapsing, but thinning. And in that environment, silver plays a unique role. It is both a monetary metal and an industrial input. That dual nature makes it dangerous. Gold can be dismissed as a hedge, silver cannot, because silver touches the real economy. Energy systems, electronics, medical technology, defense. When silver prices move sharply, they affect production. And that makes silver politically sensitive in a way gold is not. This is where the idea of release becomes important. A controlled rise allows pressure to dissipate. A violent spike forces acknowledgement, and systems avoid acknowledgement until they have no choice. So instead of asking, why is silver going up? A better question is, why isn't it going up faster? To answer that, we need to examine how modern markets actually work. Most silver trading today does not involve physical silver. It involves paper claims, contracts, derivatives, futures. These instruments allow price discovery without immediate physical settlement. This is not inherently malicious. It's how liquidity is created. But it also creates a buffer between demand for silver exposure and demand for silver itself. And buffers are tools of control. They absorb pressure, but buffers have limits. History shows that when confidence is high, paper and physical behave similarly. When confidence weakens, they diverge. The question becomes, which price matters? The paper price reflects expectations. The physical price reflects urgency. When urgency rises faster than expectations, stress builds, and stress seeks release. But release doesn't always come as an explosion. Sometimes it comes as a valve being slowly opened, measured, gradual, just enough to relieve pressure without triggering panic. That's what a controlled rise looks like. Now let's look at recent behavior. Silver has been rising, but not in a straight line. It hesitates, it consolidates, it moves in steps. This frustrates both bulls and bears. But that frustration is informative. Markets driven purely by speculation tend to overshoot. Markets under constraint tend to stair-step. Each step establishes a new range. Each pullback tests confidence, and each consolidation conditions participants to accept higher prices as normal. That conditioning matters, because when prices eventually move beyond control, the psychological groundwork has already been laid. This pattern isn't unique to silver, it has appeared before. In the late 1960s, gold was officially fixed, but pressure built beneath the surface. A two-tier market emerged, official prices stayed calm, private demand surged. Eventually, the system broke, not because of speculation, because of arithmetic. The supply of trust ran out. Silver experienced something similar in the past. In periods of monetary stress, it lagged, then caught up violently. Not because silver suddenly became valuable, but because currency confidence deteriorated past a threshold. Thresholds matter. Systems don't fail gradually forever. They fail when constraints meet reality. That's why the concept of release is so important. Release implies intent, not conspiracy. Structure. When systems are under strain, they seek equilibrium. They release pressure where they can, and they restrain it where they must. Silver sits at that intersection. Now pause here. If this framework makes sense so far, stay with me. Because the next layer explains why this time feels structurally different from past cycles. Not larger, different. In previous decades, monetary stress was localized. Today, it is synchronized. Multiple regions face debt challenges simultaneously. Multiple currencies face confidence tests simultaneously. And coordination limits unilateral solutions. This changes how pressure is managed. Instead of dramatic resets, systems prefer gradual adjustments. Adjustments that don't force immediate recognition. Silver's behavior fits that model. It is allowed to rise enough to reflect inflation realities, but not enough to signal currency distress yet. This balancing act cannot continue indefinitely, because silver is not just a monetary signal, it is a physical input, and physical constraints don't negotiate. Industrial demand does not disappear because prices are inconvenient. It shifts supply, and supply takes time, which brings us to a critical but under-discussed point. Silver supply is relatively inelastic. It cannot be turned on quickly. Most silver is produced as a byproduct, meaning higher prices don't immediately produce more silver. That matters, because when demand increases while supply responds slowly, pressure accumulates. Again, pressure seeks release. But before release comes testing. Markets test conviction, they shake out weak hands, they invite skepticism, they create narratives of exhaustion. This is the top. Demand is overstated. Technology will replace it. These narratives serve a purpose, they delay consensus, and delayed consensus extends control until it doesn't. This brings us to the present moment. Silver is rising into an environment of monetary uncertainty, industrial demand, and fragile confidence. Yet it is doing so without panic, without headlines screaming crisis, without mass public participation. That combination is rare, and historically, rare combinations precede regime shifts. Not instantly, gradually, then suddenly. The mistake many investors make is assuming release means permission. It doesn't. Release means pressure has reached a level where containment becomes riskier than adjustment. So systems adjust, a little at a time. That's where silver appears to be now. Not free, but less constrained than before, which raises the most important question of all. What happens when the pressure exceeds the ability to manage perception? That question has been answered before, and the answer is never neat. In the next part of this documentary, we're going to examine how silver behaves when control mechanisms begin to fail. How paper markets diverge from physical reality. Why timing is uncertain but patterns are consistent. And why the most important signal isn't price, it's behavior. Because when an asset stops reacting to narratives and starts reacting to structure, something fundamental is changing. And those changes rarely reverse quietly. When pressure builds inside a system, it always looks manageable until it isn't. That moment is rarely announced, it's rarely dramatic, and it's almost never predicted accurately in advance. Instead, it reveals itself through behavior, not headlines, not forecasts, behavior. This is where silver becomes especially revealing. Because silver doesn't just respond to monetary conditions, it responds to physical reality, and physical reality doesn't bend to narratives. In modern markets, silver exists in two parallel forms. The first is financial silver, paper contracts, futures, derivatives, ETFs. These instruments are efficient, liquid, and scalable. They allow institutions to gain exposure without touching metal. Most daily price action happens here. The second is physical silver, bars, coins, industrial stockpiles. This market moves slower, but when it moves with purpose. Under normal conditions, these two markets stay aligned. Paper leads, physical follows. But history shows that alignment only holds while confidence remains intact. When confidence weakens, the relationship changes. Paper becomes expectation. Physical becomes necessity, and necessity always has the final vote. This divergence has appeared before. In the late 1970s, inflation rose steadily. For years, precious metals moved, but not explosively. And then something shifted. Public confidence in monetary stability crossed a threshold. Gold surged, silver followed, violently, not because silver was suddenly discovered, but because the system could no longer manage perception. The paper market lost credibility relative to physical demand. That moment is often misunderstood. It wasn't manipulation failing, it was structure failing. Paper claims multiplied faster than physical supply. And when too many participants wanted delivery instead of exposure, the system had to reprice, not gradually, suddenly. This pattern isn't unique to that era. It repeats whenever three conditions align. First, rising monetary stress. Second, constrained physical supply. Third, delayed public participation. Silver today shows all three, but with a crucial difference. Industrial demand now dominates the equation. Solar energy, electronics, medical uses, defense systems. Silver is embedded in technologies that are politically and economically non-negotiable. That changes how shortages are resolved. You can't substitute trust. You can't delay physics. If silver isn't available at expected prices, something else has to adjust. Either demand falls or price rises. Demand falling would require banning strategic industries. That's unlikely. Which leaves repricing. But repricing doesn't need to be explosive to be meaningful. It only needs to reset expectations. This is why the current phase feels controlled. The system is testing higher prices while monitoring response, not just investor response, industrial response, supply response, public response. This testing phase is critical because it determines how far and how fast release can occur without triggering broader instability. This is where many observers misinterpret what they're seeing. They expect fireworks. Instead, they get patience. They expect headlines. Instead, they get silence. But silence doesn't mean nothing is happening. It often means decisions are being made quietly. Now consider another historical parallel. In the early 2000s, housing prices rose steadily, not explosively at first. They were supported, normalized, accepted, until the system became dependent on that support. And when it failed, the adjustment was not gentle. Silver differs in one key respect. It's not debt-based. It doesn't rely on leverage to exist. That gives it a different failure mode. Instead of collapsing, it reprices. That repricing can be delayed, buffered, managed, but not eliminated. Which brings us to a subtle but important distinction. Release does not mean freedom. Release means pressure management. Think of a dam. Water can be held back only so long. Eventually gates are opened, not to flood downstream, but to prevent collapse. That opening is controlled, measured, but it acknowledges reality. Silver's movement suggests gates opening, not bursting, yet. And this raises a question that many avoid. What determines when controlled release becomes uncontrolled? History suggests it's not a single event. It's accumulation of debt, of promises, of expectations. When the gap between paper claims and physical reality grows too wide, confidence erodes. Not publicly, privately. Institutions adjust behavior first, then sophisticated investors. The public is last. That order matters. Because by the time public narratives shift, prices have already moved. This is why silver's current behavior is so instructive. It is rising without public enthusiasm, without widespread media coverage, without retail frenzy. That's not weakness, that's insulation. Insulation from emotional excess, which makes moves more durable. Now let's address a common counter-argument. What if this is just another false breakout? It's a fair question. Silver has frustrated participants for decades, but that frustration itself is part of the pattern. Assets that are allowed to move freely attract speculation. Assets that are restrained exhaust patience. They filter participants. By the time release accelerates, only conviction remains. This has happened before. Gold spent years consolidating before major repricing. Those who left early missed the move. Those who stayed didn't need to time it. Timing is often overstated. Positioning matters more, which leads to an important clarification. This documentary is not suggesting certainty. There are no guarantees, no dates, no targets. History doesn't repeat perfectly, but it does rhyme. And the rhyme here is unmistakable. Controlled price action during rising systemic stress, growing divergence between physical importance and financial representation, increasing dependence on an asset that cannot be easily scaled. These conditions don't resolve quietly forever. They resolve when adjustment becomes unavoidable. The mistake many people make is waiting for confirmation. But confirmation always comes after repricing. By the time consensus agrees, the opportunity has passed. This doesn't mean panic is warranted. It means awareness is valuable. Understanding structure allows calm decision-making, which is precisely why silver matters in this discussion. It sits between worlds, between finance and industry, between hedge and necessity, between perception and reality. That position makes it a signal, not a prediction, a signal. Signals don't shout, they whisper, until they don't. As we approach the end of this documentary, it's important to emphasize what this is not. This is not a call to action, not a warning of imminent collapse, not an argument that silver must explode. It's an examination of why silver's current behavior aligns with historical release patterns, why slow movement can be more meaningful than fast movement, and why silence can be more informative than noise. Timing remains uncertain, always, but structure reveals direction long before speed. And structure is what we've examined here. If this next part is making sense, it should feel unsettling, but not frightening, because understanding removes panic. Panic comes from surprise. Patterns remove surprise. Now consider where this leaves us. Silver is rising, but not screaming, not demanding attention, not forcing consensus. It is being normalized at higher levels, step by step, range by range. That normalization is the quiet work of repricing, not liberation, yet. And that unresolved tension is the point. History never announces the end of containment. It reveals it afterward. The question isn't whether silver will move. It's how the system responds when it does. And that response depends not on markets, but on confidence. Confidence in money, confidence in institutions, confidence in the future. Those are fragile things. They don't shatter loudly, they thin quietly, until one day something changes. And only in hindsight does it look inevitable. That's why this conversation matters. Not to predict, but to recognize. Because recognizing patterns allows you to think independently. And independent thinking is rare during transitions. If you value that kind of understanding, explanations of systems rather than headlines, consider staying connected, not for answers, but for frameworks. Because the world doesn't change all at once. It shifts, quietly, then suddenly. And silver right now is whispering,